Well, first of all, thank you very much for staying for the graveyard slot and for me allowing to keep you from your drinks. I just start with a little bit about Peel Hunt, because I'm assuming that not everyone knows who Peel Hunt is, and this gives me a chance to declare a vested interest in that we are big supporters of UK equities, UK markets, UK economy, everything UK. And so when we're talking in the press, talking on LinkedIn, talking in our research, we definitively have a vested interest and we aren't shy about it. And that's because we are one of the largest stockbrokers, investment bankers in the UK. We look after 145 corporate clients, and we're very proud to represent companies like Games Workshop, which has been one of the best performing companies worldwide, let alone one of the best in the UK. We also look after AIM companies like Boku, and so we have a very broad spread of UK and international businesses. We, unfortunately, are very successful in UK M&A, and I say unfortunately because that means we are selling a lot of our companies to overseas acquirers and to private equity, but that's a key part of our business. But one of the major aspects of what we do is provide liquidity for retail investors. And this is a really important part of our service. You heard just now from Winterfloods. Winterfloods and Peel Hunt are the two big market makers in the UK. And we ensure that UK investors can very actively trade across FTSE 100 all the way down into the small caps. And that is very different to the US, where it is much harder to trade smaller companies than it is in the UK. And that's because the likes of us and Winterfloods are there to be able to provide liquidity. What we've also done over the last few years is founded Retail Book, and you may have heard from them earlier, and this is providing access for retail investors to IPOs and equity fundraisings. And you may know that Retail Book has recently taken on people from Primary Bid, so it's now the primary supplier of product to retail investors, and also it has now moved out of Peel Hunt, so it's now majority owned by third parties, and we always thought that this would become an industry standard business. We didn't want to own the whole company. We wanted it to be there to ensure that retail investors had access to the market. But what it really does is gives us a voice to be able to talk about retail to regulators and to government. I put importance of public markets up here, and this is something that a lot of people don't realize. And this goes in government, it goes in regulators, among the general population. They just don't know how important public markets are. And part of what I spend a lot of my time doing is education as to why public markets matter. And the reality is they're taken for granted. I think a lot of that is because we have 100 FTSE 100 companies, obviously. We have 250 FTSE 250s, obviously. So people don't see what's going on in the UK public markets and see that we have been losing out to global markets and particularly to the US. They don't realize how important it is for economic growth. If you're sitting in the States, everyone would know there is a direct linkage between public markets and their personal wealth, their spending power, and economic growth. It would not even be a conversation you had to have. In the UK, we somehow think that public markets are divorced from economic growth, despite the fact that the FTSE 100 provides over 10% of the entire tax take in the UK. So it's all about wealth protection, wealth creation. We shouldn't be shy about that. We should be shouting about it from the rooftops, saying this really matters for the whole country. It's not just about retail investors, it's about the whole country. It's also about financial inclusion. And again, this is something that just gets totally forgotten. And one of the things that we've been talking about government is you do realize that when companies go private, they're owned by very few people. When companies are public, every single person can own a share in that company. Tax generation is really important. It's not just about corporation tax. It's also about stamp duty, which is far too much, over £4 billion a year, but that's another story. It's all about tax on dividends, and UK companies pay a large amount of dividends, £80 billion a year. And then it's CGT. So the overall tax take from public companies in the UK is enormous and considerably more than private companies. And if you don't believe me, you just need to look at the accounts of Asda and Morrisons that used to be big FTSE 100 companies, used to pay a lot of corporation tax, now hardly pay any. And that is because one of the structures in private markets is to ensure that you pay low corporation tax, either by gearing up the balance sheet or by coming up with different structures. One of the other aspects that I talk about to government is having permanent capital is really important. Public markets were really powerful during COVID. Public companies stayed alive, they didn't take taxpayers' money, there was huge funding from institutions, and you never have to pay it back, you never have to pay a coupon. Soft power is also something that is not understood. America gets huge soft power from the likes of Microsoft and NVIDIA. Any government in the world, if the boss of Microsoft is saying, I want to have a meeting, they are going to have a meeting. We get soft power from the likes of Shell, AstraZeneca, Rolls-Royce. These are really important businesses for the UK. Lose any of these important businesses and it diminishes the UK. So what we've got here is public markets are really important for value creation, for jobs, for tax revenues, and shouldn't be taken for granted. And the reality is, for about 25 years, they've been taken for granted. So what's going on that is creating these problems? Well, globalization of capital is really important. It used to be that most people, most institutions invested in their domestic economy. Go back 25 years, 40–45% of pension fund money was invested in the UK. Probably 50–60% of retail investors were invested in the UK. So it wasn't even an issue to worry about globalization of capital. Now we're in a situation where it's cheap to trade overseas. It's accepted to do so. Pension funds can trade overseas. Wealth managers will now increasingly have portfolios where there's a large weighting of overseas companies. And the reality is, this is diminishing our UK markets. We've got to realize that and realize that we're in a fight for capital. If we don't retain it in the UK, we won't have a successful economy. It's as simple as that. Secondly, passive investing barely existed 25 years ago. Now it's vast. Huge amount of money going into passives. It's reducing active investment. That has real implications for capital markets. We all know about pensions selling out of the UK. It's a whole litany of issues as to why that has happened. It's tax rules, it's accounting rules. Gordon Brown has a lot to answer for with a dividend tax, ACT being taken away. And as a result, we have had something like £1 trillion worth of selling of UK equities over the last 25 years. When you've had that wall of money coming out of the UK, it's no surprise that the UK has underperformed. Unfortunately, we've got a situation where the defined contribution pension funds, the replacement, those are going to be vast, but those are underweighting the UK. And you may have read recently, we've had Scottish Widows, one of our leading providers, reducing their allocation to the UK from 12% to 3%. So it is an extraordinary situation when people who live in the UK, who pay their tax in the UK, get a tax break in the UK, they get paid by the company, Tesco, they pay £315 million a year into their employees' pensions. You then get the employee contribution, you get the government contribution, and the vast majority of that goes to grow companies in the States. More of it goes into Walmart than goes into Tesco. It is bizarre that we have allowed this to happen. Increase in private capital. Now, I've got nothing against private capital. There's some very successful private capital businesses. The reality, though, it's become a challenge for the UK market and the UK public market. It's now got to such a challenge where actually people running private equity funds are desperate for the public markets to perform again because they're getting to the stage where they are needing to float their businesses and they need the UK public market to work. One of the problems, and some of you have heard it just now, is the transaction tax on the UK, stamp duty. Unfortunately, it's the second highest in the world. The only one higher is Ireland at 1%. We've got 0.5%, and you've probably seen what's happened to the Irish stock market. It's pretty well disappeared. It's a ridiculous tax to have when you've got globalization of capital, but it's 4 billion quid, and so it is difficult for Rachel Reeves to get rid of it at a time when she's having to give lots of money on people on benefits. So where we are now is that we're seeing growing competition from international exchanges. That is not going to diminish. That is only going to increase. We have growth in international ownership. That is now over 60% of the FTSE 100 is owned by international investors. We cannot expect our companies to stay in the UK if we don't do anything to encourage them to do so. And when they choose to leave, it's going to be too late. And you've probably heard Shell a couple of years ago were muttering about this. AstraZeneca were muttering about it. Glencore have been looking at it. If you look down the list of the top 100 companies, the majority of them will have considered changing their listing to the US predominantly. And the first the government will know about it generally is when it's actually been announced. And then we'll not have the tools in the box to be able to keep those companies in the UK, because the reality is the investors are overseas nowadays. So when Unilever stayed 7 or 8 years ago, the investors were able to defend it and say, no, we are not going to accept you moving. Then it was moving to Amsterdam. We wouldn't be able to do the same thing today. If Unilever chose to move, it would go. So government really has to focus in on that. One last thing that we don't have is a sovereign wealth fund. Pretty well every successful country in public markets has a sovereign wealth fund. You know, Singapore has Temasek, Abu Dhabi has ADIA. The US effectively has that massive pension fund in the 401ks. So everyone else has something that keeps companies listed in their home market. So this is what we've been talking about to government. A few years ago, it was falling totally on deaf ears. Everyone would say, no, it's absolutely fine, don't need to worry about it. Credit to Jeremy Hunt, he started the conversation going that said, actually, we need to do something about it. Unfortunately, he decided to do something about it in June of last year, which was too late. And equally, unfortunately, some of the good things that he was doing were then immediately reversed by Rachel Reeves. So that was deeply disappointing. But the positive bit is there's no longer a dispute about the fact that we've got a challenge. There's no longer a question mark. I'm not having to persuade people anymore and shout at them to say, look, you need to take this seriously. Now it's a recognition that we have an issue. We need to come up with measures that enable public markets in the UK to thrive and prosper if we want to have a healthy economy. It's really a question now about what we do and how we do it and how quickly we do it. Politicians are very good at listening, very bad at acting, because generally they listen to the people who say no than the people who say this is something that will be really exciting and bold and change everything. But there is plenty of discussion, and I sometimes feel I'm hitting my head against a brick wall repeatedly, probably a sign of madness, but the reality is there is engagement amongst a number of people within Whitehall and within government. I go and speak to people in Number 10. Last week I had a cross-Whitehall meeting with people from the DBT, from the British Business Bank, from Treasury, Department of Science, and having exactly this sort of conversation, because I've realized I cannot assume that everyone understands this. So there are some reasons to be a little bit positive. As I've just said, broad recognition that change is required. We have had a fundamental change in regulations, and I think probably people don't realize how significant this is. I'm having regular conversations with the FCA where they are saying, what can we do to reduce regulation? What can we do to promote growth? I've had one last week, I've got another next week, and this is about taking away the barriers to IPOs. It's about reducing the costs on our business. It's about enabling more retail participation. And the sort of conversation we're having now, I could not have had literally a year ago. That is a massive change. And you can see that throughout all of our regulators. And credit where credit is due. I think Labour and Rachel Reeves in particular has been very strong on regulation and actually said things that probably under a Conservative government would have been seen as unacceptable. Now it's seen as something that actually just has to be done, and the regulators are now grasping it. It has to go all the way through their businesses, and it takes time because they've got thousands of people, but at least it is now happening, and it is definitively happening at the top. We are addressing risk appetite, and this is something that has been a British disease for the last 25 years, but well, certainly so ever since the financial crisis, as the overprotection of investors. You can lose money in your house, you can lose money in cryptocurrency, but apparently losing money in the stock market is forbidden. And so the risk warnings are ludicrously overprotective. And what they do is effectively say, you're much better off putting your money into a safe, secure bond that underperforms equities, it underperforms inflation. And so these sorts of things are now being unwound, and the FCA is looking at the risk appetite statements. And I think that actually will make a difference. It'll take time, but it will make a difference. UK is definitively a more attractive market. We see ourselves as a national champion, taking UK companies to global investors. And we get a much better hearing now than we ever have done. And so the international investors recognize that the UK is a cheap market. They recognize that the UK is a sensible economy to be able to invest in. And what we're definitively seeing is an increase in allocation by global funds. So that is all happening. But, and it is a big but, the bizarre thing is UK investors are still selling the UK. The very people who ought to understand what's changing are the ones that are going global, are the ones that are going into the US at the same time as the US is going into the UK. It's a bit bizarre. We're still seeing a load of companies exit the market. M&A continues to be elevated, and IPOs, the pace is pedestrian, is saying politely to pedestrians. So what's going on that is driving all this? And it's capital. It's really simple. Capital makes a dramatic difference in equity markets. The more capital you have, the more the market goes up. It's not rocket science. And what we have been seeing consistently is the blue bars there are the sales of UK funds, and the rather tastefully orangey color at the top is the flow into international funds. And this is UK investors consistently selling UK companies, consistently going into global. And this is a real problem for the UK market because it is undermining the UK asset managers. And this has a bigger impact the more you go down the market cap scale, because the international funds will typically buy the largest companies. It's the UK funds and UK retail that own the smaller companies. So this is something that we are seeing on a very consistent basis across a very broad spectrum of our asset managers in the UK. And why does this matter? It matters because it is the UK fund managers that typically support UK IPOs and UK capital raising. So the public markets are not able to do what they are there to do. They are not able to support growth companies in the way that they should. And then passives is also a major issue, and I've got nothing against passives. They have democratized the markets. They're a very cheap product. They enable you to get access to investment without having to know much about it. So there's lots of good stuff about passives, but we've got to a tipping point where passives are now eating the market that has enabled them to thrive. You can see here the blue bars again are the sales of shares by UK investors out of active, and the green bars at the top are the move into passives. It's really consistent. We've seen it now. This is 2 years of data, but it's been going on for 4 years in terms of fund flows out of the UK. It's been going on for 20 years in terms of actives going into passives. So why does this matter? Passive investors don't do IPOs. So the lifeblood, the creativity, passive investors are not there. They don't support capital raises. They might come in at the end, but they are not there to create the environment where we can go to a company and say, we're going to raise you money. It's becoming increasingly hard because the passive investors are not enabling those discussions to take place. They also favor mega companies. So this takes money away from smaller companies, particularly from AIM. AIM does not have passive investment. It then moves it into the largest companies, and obviously increasingly into the largest companies in the world. And that is why we have a massive overweighting to the Magnificent Seven. So it's an issue for investors generally, but it is particularly an issue if you are a regulator or a government worrying about the importance of public markets in driving economic growth. And this is where we've got to. Not that long ago, 20 odd years ago, we used to talk about the FTSE 250 as one of the best indices in the world, and the FTSE 100 was matching the S&P 500. But what we've now seen for many years is the S&P has been tearing away, and obviously it just dominates the global indices now, 60% of asset allocation. The European indices, the stocks, it's 10 trillion compared to 40 trillion for the US. What I find deeply disheartening is when you realize that NVIDIA is bigger than the entire FTSE All-Share. And this brings it home. If you are a global fund manager, you are making a decision. Do I invest in the FTSE All-Share or am I investing in NVIDIA? They have the same weighting for you. And then when you go down into the FTSE 250, the FTSE 250 is just a little bit bigger than Costco, one sort of reasonably sized American company. So what this is meaning is that global funds are increasingly dependent on the US market. It's really driving a massive exposure to the Magnificent Seven, and it's driving a huge exposure to the dollar. I thought it might be quite interesting just to see what you invest in if you invest in Nest. Now, Nest is our largest auto-enrollment pension fund, defined contribution fund. It's been a fabulous success since auto-enrollment started a decade ago. It is now getting on for 50 billion of assets under management. It's got something like 13 million UK citizens contributing to it every single month. So they have a lot of equities in there. Absolutely right, they should do. And that's because most of the people investing in Nest are younger people. They should be in the highest performing assets, and the highest performing assets for a very long time are equities. Look at the amount that goes into the US. 60% of every monthly salary that they put into there goes into the US. And the top 10, it's getting on for 25% going into the top 10. Guess what? They're all American companies. Microsoft is as big as the UK. So it's an extraordinary situation where all of these people saving through Nest are essentially saving in the US predominantly, and they're getting company money for doing so and taxpayers' money for doing so. It is bizarre that this is the situation that we have got ourselves into. No, we can't blame anyone else. Other countries don't do this. If you look at Australia, they put 20% of all of their money into Australian stocks and shares. We are putting less than 5% in Nest. And these are all people who are going to live in the UK, retire in the UK, rely on UK public services. They should fundamentally care about how their money is invested. Guess what? Most of them haven't got a clue. And so I was at a conference recently, and a company called New Financial, which is brilliant at analyzing data. They did a poll. And the poll asked lots of ordinary people in the UK who had a pension how much they thought their pension would be invested in the UK. The answer, 41%. So 41% of their pension they thought would be invested in UK companies. So that compares to 4 or 5% in reality. So people have no idea what is in their pension. They have no idea that they are massively overweight US, they're massively overweight US technology, they're massively overweight the dollar. Guess what? That's been underperforming for the last year quite significantly. So this should be really thought about. You are living in the UK. Over the last 25 years, being exposed to sterling has not been a good thing. Let's hope being exposed to sterling is a good thing for the next 25 years, in which case this is a disastrous asset management strategy. Thought I'd just show you what's been happening to a couple of our leading investors in the UK. So St James's Place on the left, a decade ago, over 20% of assets were in the UK. That's now sub 10%. It's en route to 5%. They're also going increasingly into passive investment because it's cheaper. I won't go through the Hargreaves Lansdown little color chart. It's probably a rainbow chart. But what this effectively tells you, if you see the bars, so the blue one at the bottom, then there's a yellow one, and then there's a green one. Those collectively are UK equities, income funds, and smaller company funds. They were 50% exposed to the UK a decade ago. And this is retail investors' money voting with their feet. That is now down to 30%, still 30%, so still good, but the direction of travel everyone can see. And it means that the marginal pound is being put into global funds. So what you can see here is wealth managers are moving out of the UK, people investing through our Hargreaves Lansdown are going out of the UK. It's no wonder we are seeing that continual outflows. The question is it the right thing to do? What does it actually mean for the companies? Well, this is the AIM market, and what you can see here is the number of companies on AIM have shrunk by 55% over the last 5 years. Sorry, 4% over the last 5 years, but the market cap has shrunk by 55%. So a significant reduction in available market cap. And you remember I talked about earlier, the FTSE 100 is still 100 companies. So where do we see the impact of all that M&A? We see it in the FTSE small cap. Because now those companies that were in the FTSE small cap are going up in the FTSE 250 to replace the ones that are moving up into the FTSE 100. Market cap in the FTSE small cap has diminished by 48% in the last 5 years, number of companies by 36%. So what we are seeing here is a significant de-equitization happening in the small and mid-cap space, and that is why valuations have been so low. And this chart talks a little bit about what we are seeing in terms of M&A and IPOs. And the blue bars are M&A, and unsurprisingly, the red bars are IPOs. So by number, we have had 5 IPOs of note over the last couple of years, and 121 companies being taken out over 100 million market cap over the last 5 years. It's 100 billion of equity has left the market, 2 billion has joined it. Who's buying them? 60% are corporate acquirers, over 50% are overseas acquirers. This is really being noticed by government, that we are losing a significant base of our growth companies that will be potentially the FTSE 250, the FTSE 100 companies of the future. And this is important because this is losing taxpayers' money. And one of the things I say to them is, you cannot be complacent here. Do you realize what would happen if Shell was to leave? It's probably over 2 billion of tax is lost immediately in dividend tax, stamp duty, corporation tax. £2 billion. You know, it's a really important number, just one company. So we have to do something about this. The good news from an investor's point of view is this M&A is making share prices go up. And you know, you've probably seen recently, we've had Spectris, a battle of the titans of overseas private equity companies fighting over Spectris, 100% premium. Alpha Wave going up at a 96% premium. We have actually had some good news this week with a victory for PHP fighting off KKR with a battle for Assura. So there we do actually have investors are voting with their feet to keep companies in the UK. So the UK has faced a perfect storm. We have had investors selling out of the market. We've had pension funds selling out of the market. We were overweight financials when the global financial market. We had the self-inflicted wound of Brexit. Whether you like it or not, it has impacted our economy. We've been highly dependent on energy. The balance sheet of the UK has been really struggling. So lots and lots of reasons why the UK has been troubled. But we are now in a situation where some of our friends overseas are struggling a little bit more, and that is helping us look more attractive to overseas investors. Inflation is coming down, interest rates are coming down, and Labour haven't covered themselves in glory, but at least it isn't the mess that we had previously. We do also have a huge number of strengths. We have really solid consumer balance sheets, really solid bank balance sheets. So although the government is over-levered, the rest of the economy isn't. What that means is that if we get a bit of confidence, the UK can perform really well. We also are global leaders across a really broad range of industries. The financial sector is a global leader. Thankfully, we're finally no longer being punished for the global financial crisis, only 17 years later, but at least that is now happening. Technology, we are a leader. Legal, we're a leader. Pharma, we're a leader. So we do really have a resonance to a lot of international investors. And we're in a situation now that if we can get pro-growth regulatory reforms, if we can crowd in foreign investment, we can start to get the UK moving again. We still do have the best small and mid-cap market in the world. And I don't say that lightly. It is in the world. Europe does not have a small and mid-cap market. America, because of the dominance of the Magnificent Seven, those smaller companies, and when I say smaller in the US, I'm talking less than $10 billion market cap, they struggle for airtime with US investors. We have an opportunity to have the best market in the world. So the question is, what do we do to deliver that? And these are the things that I'm talking to government about. And some of them, as I said, I'm beating my head against a brick wall, but they are listening and they are thinking about changes. So one really easy thing for them to do is the British Business Bank has been a great success. And it's not necessarily high profile, but it is being awarded more money by government. It now funds 20% of venture capital in the UK. That is a dramatic increase in only 10 years. This is something that actually Vince Cable did that was a terrific success and has massively outlasted him. So credit to Vince on this particular one. If the British Business Bank was able to invest in IPOs, able to support UK growth companies, that would be a significant change in dynamic in the UK. It would put capital directly into UK companies. But what it would also do is say to pension funds who have committed to putting more money into the UK, come and join us. It would say to sovereign wealth funds, look, we now have a champion for the UK. It would be so much easier to go and get money from the Gulf. So if you see the British Business Bank starting to get a mandate to invest in the UK, that is a massive positive buy signal for the UK market. It would not take a huge amount of money. British Business Bank now has 27 billion. So they can do this. And actually, Labour have spotted this. And in their financial review, they talked about something called the TIBI scheme, T-I-B-I. This was a scheme in France that was designed to take money from pension funds, or invest money rather than take money, and to put it into growing the technology sector in France. It's been a terrific success. They are now listing companies in France that are technology businesses that would previously have probably been sold to an overseas buyer or listed in the States. It can be done. So that is a really easy give that actually wouldn't cost the government any money at all. Pension and ISA reform has been very topical, lots of chat about it. The government inch their way to a solution and then someone says no and they go, oh no, that's far too difficult. So cash ISAs, those who are old enough will remember that in PEP world, you didn't have cash ISAs. It then got a small amount that would be put into cash, much larger into stocks and shares, and then George Osborne in his wisdom decided, oh, let's make it simple and equate the two. As a result, cash has become a very large part of our savings market. It is now over £400 billion. It's a huge saving product. And it's a total misnomer because you hardly save any tax by putting people into a cash ISA. Most people are not saving enough cash to get a benefit from having a cash ISA, and yet they're being put off investing in stocks and shares, which can deliver you a decent dividend income as well as capital growth. Rachel Reeves understands this. She's got to get her head around the building societies who claim that it enables them to offer lower cost loans, which is total rubbish. But anyway, they've won that argument for now. We'll see how that one plays out. Similarly, back in the day, PEPs, you had to invest half of it into the UK. It just made perfect sense. You are being given a tax break. Why are you then using your tax break to invest overseas? Personally, I love it. I invest a lot of my ISA overseas, and it's been great. But I cannot understand why I'm being given a tax break to invest in NVIDIA. I should be doing that outside a tax wrapper. So those are the sorts of things that could make a dramatic difference, that if we can change the ISA, change pensions, we need to have our UK pensions investing back into UK companies. As I mentioned, Australia, they put 20% in, and they're really proud to do so. If you look at an Australian pension fund, the Aussie Superannuation Fund, they have grown fantastically well. They have declaimed from the rooftop how they are putting money into Australia to grow the economy, to make it a better place to retire. Have a look at the Nest annual report. Doesn't even mention the UK. Now, they are changing, to be fair to them, but it is still small beer compared to what's going on in Australia and similar other countries around the world. We are the outlier here. I mentioned regulatory reform. That is happening. That is really positive. Stamp duty, it's going to be very difficult to win that battle with the current government. I think the previous one was starting to realize that it had a real impact on our competitiveness and needed to be looked at. What I'm trying to say to government is just do a review, have a look at it. There are so many anomalies in stamp duty that a lot of people don't even realize. No, you don't pay stamp duty on Glencore, for instance, whereas you do on Rio Tinto. You don't pay stamp duty if you buy a Barclays ADR, but you do if you buy a Barclays share in the UK. It makes no sense. So they should look at stamp duty. They could reduce it, broaden the scope, and make it a similar amount of revenue raised, but make us more competitive. But one thing I'm really asking for is a stamp duty holiday on IPOs. At the moment, if they're not getting IPOs, it doesn't cost them anything, they aren't getting the tax. So this would be a really good way of encouraging companies to list in the UK. One of the things I'm also saying is it is bananas that we have exactly the same tax rules for investing in the UK as we do for investing overseas. Why don't we have lower CGT for investing in a UK company that helps grow our economy rather than someone else's economy? Why don't we have a lower dividend tax? Now, it's going to be a hard battle to win, but that's one I'll keep on fighting on. One of the things that is definitely now changing is a recognition that we need to grow retail investment. We are woeful. We used to be really good at it, and as everyone will know, back in the day of privatizations, everyone was doing it, filling in multiple forms to do water companies or electricity companies. But it's gone over the last 25 years for numerous different reasons. We now have 8% of our wealth in equities. Americans have 34%. Guess what? The Americans are much wealthier than we are. And it's not rocket science to work out why. Now, Rachel Reeves totally gets this. And so there is a drive to make retail have a focus, to have a long-term plan. Sweden's done this very successfully over 20 years. They've created an equity culture. We need to build that in. It can't just be about getting 20-year-olds to gamble on cryptocurrency. That's where we are at the moment. We're not educating them that investing in companies that pay a dividend, that grow the economy, that you might work for, all of this is really important and tied up together. We should have everyone in companies getting shares in those companies with really proper tax-driven reasons for doing so. So there's a lot we can do. And the encouraging thing is I'm engaging with a lot of Labour politicians who are really focused on this, and they're creating groups to be able to start to change the dynamic, to tell people how important it is to be invested in your own economy. And one throwaway line that came out in the Mansion House speech a few weeks ago was a listings task force. At Peel Hunt, we're involved in this listings task force. It is rather a grandiose title for a conference call, but let's go with it and say it's a listings task force. But what it does mean is that we have direct ability to go to number 10 with a series of proposals to change the dynamic of the IPO market in the UK. I've been discussing with people like the FinTech Unicorn Council what can be done to encourage companies to list in the UK. And this is the really important thing. We have an extraordinary scenario at the moment where venture in the UK is really successful. We're really innovative. We create a lot of new businesses, but we are dreadful at scale up. We are dreadful at listing companies and enabling them to grow. And previous speakers have talked about, the biggest companies in the world are all listed. If you're Google or if you're Amazon, if you're a Microsoft or you're Nvidia, they're all listed. And yet in the UK, it doesn't seem to be something that is proud, that we should be proud about. We don't have entrepreneurs going, I'm going to list my company, it's terrific. The good news is there are loads of really good companies that are wanting to list in the UK now. But they are saying to government, you have got to make it so that this is the venue of choice. You cannot say to us, it's your patriotic duty. And the problem all of these companies have, or a lot of them have, is that a lot of them, the people on the cap table are overseas investors. They've got a lot of US investors. They've got a lot of Middle Eastern investors. These are terrific businesses that will be global leaders of the future. And if they have a lot of overseas investors, then those overseas investors will say, come and list in NASDAQ. We'll give you a better valuation. Don't worry about those pesky UK retail investors. This is all about our investment. The good news is we've got a lot of genuinely patriotic entrepreneurial leaders that want to list in the UK, but they need to have a reason. So we're engaging with government, we're talking to these companies, we're saying create an environment that you can encourage these companies to list and stay. And stay is really important, not just stay in the UK from an IPO perspective, but stay domiciled. Now, I have to say the most depressing thing for me is when we enable a founder to effectively create wealth and to then crystallize that wealth, and then they go and live in Monaco or Italy or wherever. That is deeply depressing. And isn't it extraordinary that we have a tax system that encourages them to do that? We need to have a tax system that encourages them to list in the UK and stay in the UK. So if we get this right, we can change the dynamic. We can have the best companies listing in the UK. If we'd had Arm list in the UK a couple of years ago rather than list in the US, and that was the biggest miss of the Sunak government, we would not be talking about the UK being moribund and the UK not having the best growth companies in the world. We would be excited about the UK, and there would be a queue of technology-based companies coming through as well. We do have some of those companies that will list in the UK, and the dynamic will change really quickly. So if we get the listings right, if we get the capital right, the overseas investors already recognize what's going on. We need the UK investors to recognize what's going on. So just leave you with one last chance, and this is from, I think he's been quoted a number of times, Duncan Lamont at Schroders, so call out for Duncan, who is terrific, and follow him on LinkedIn if you don't, because he provides loads of information that explains what goes on in capital markets globally. This came out this week. I thought it was a really interesting chart. This is data from the US that's saying that US investors are prioritizing investing in the UK. So at the same time as we are sending our money to them, they're sending their money to us. Now, if the UK investors realize that actually global investors see huge value in the UK, then people would start changing their tune, and we would change that dynamic of UK selling out. We'd then have a scenario where the outperformance of the UK market, which is up 12% year to date, would become entrenched. And part of the reason is the US investors, they're making really good money out of the UK because they've not only got the 12%, they've also got the 10% from the dollar weakness. So this is a core driver of the UK market. So I look at the scenario at the moment and think we've had a really tough ride. It's been difficult to be positive. I don't find it difficult to be positive anymore. I find loads of reasons to be super positive about the UK. We still need to have some policy decisions that really entrenches that and makes us potentially one of the best performing markets worldwide for the next 20 years. And that means we can then start to drive our economic growth as well. Thank you very much for listening.